I am going to mute everybody because we are going to begin. My name is Teresa Jacobellis. I work with Henry at HITS Consulting Group, and I'd like to welcome everybody to our presentation on regulatory changes, the CARES Act, and your practice. I want to thank you all for joining us, and I want to specifically thank our two presenters, the experts that we've brought in to answer all of your questions and help all of us sort of navigate this very challenging time that we're encountering. Just a little bit of housekeeping to get us started. This is a Zoom meeting, not a webinar. That means that I'm going to keep you all on mute during the presentations just to prevent any background noise and distractions. If you do have questions for the presenters when they're speaking, if you don't mind, just go ahead and type those into the chat section, and we'll save them to the end, and chances are that they will be answered during the presentation. If they're not, then we'll have time at the end to get to all of your questions. Our two presenters this afternoon are Roy Breitenbach. Roy is the co-chair of the litigation group at Garfunkel Wild PC, which is the preeminent health law firm in the tri-state area. Roy uses his 25+ years of civil trial experience to help healthcare providers creatively, successfully, and cost-effectively avoid and resolve disputes with managed care companies, employees, business partners, and disability access claims. With his extensive trial experience, he is able to quickly identify and develop the key issues that will lead to a favorable result. And Roy frequently lectures and writes on significant legal and business issues affecting healthcare providers. Before we bring Roy out, we're going to hear from Joseph Tomaino. Joe is the Chief Executive Officer of Grassi Healthcare Advisors, LLC, and he brings over 30 years of healthcare management experience working in the not-for-profit, for-profit, and government-sponsored segments. As a CEO, Chief Nursing Officer, consultant, and educator, Joe has worked with provider organizations and payers across the United States as an architect of value-based care, improving clinical effectiveness along with efficient use of resources. Joe uses data to analyze populations being served as well as an organization's effectiveness, and then applies innovative structure and program designs to improve performance, helping clients transform to successfully operate in a managed care and accountable care reimbursement environment. Prior to joining Grassi, he was CEO of the Continuing Care Division of Catholic Health Services of Long Island. And he has advised both payers and providers to redesign processes and to be in alignment with emerging value-based payment methodologies. So we're very, very pleased to have both of these experts here with us today. And before we let them get started, I'm going to turn the floor over to Henry Dennis, who wants to make.
Thank you, Teresa. Thank you, everyone, for participating in this webinar. We know that we put it together real fast. And thank you, Joe. Thank you, Roy, for making this happen. Without your expertise, this would not have happened. So we really wanted to have our base hear from the experts. Everyone obviously is affected by this pandemic, small businesses in particular. We know that the CARES Act was signed and everybody's trying to get the help that they need. And everyone has been calling and asking, well, what are the tax implications? What are the legal implications? Is there going to be an audit? How do we do to prepare for this, that, and the other? None of this is my expertise. Hence, we have Joe and we have Roy. So with that, I'll turn it over to Joe first for his presentation. And then, as Teresa said, type your questions into the chat box as we go. And I'm sure that by the end of the presentation, most of them will be answered. And if not, we'll take the time for Q&A. Thank you all for participating.
Okay, can you hear me now? Good, good. So let me just share my screen. Thank you for that nice welcome. Let's see. Teresa says host disabled participants screen sharing. So you got to enable me. Or you can just pull up my slides if you have them. There we go. Good, good. So let's see here. Can I? If you can hit slideshow up here and do from the beginning. Beautiful. Great. So, and next slide, please. So, we're in the middle of this COVID crisis. It's a significant event for you as medical providers and healthcare businesses, because as much as people see that we're very busy in healthcare, and believe me, we've been busy, the core business that we do has been really severely impacted. And most of the practices I work with have had anywhere from a 30 to 80% reduction of billable regular work that is part of your regular business. So that makes an incredible impact in your cash flow, not necessarily right now, but a month or two down the line, when you normally would be getting that revenue in, is when that's going to really hit you. So before we get into the CARES Act, I just wanted to briefly show, next slide, please, how you can prepare for this. And this is just a little tool that I've developed, because I know that many physician practices, smaller businesses, tend to just work out of the checkbook. They don't really have a budget. They don't really monitor cash flow on an ongoing basis. And now more than ever is the time you really need to do that. And I'm a nurse by background, so I'm going to give you an analogy to think of that you can relate to as clinicians. Think of it as an INO sheet, intake and output. Okay. You got to monitor the top side is your intake. What's going to be coming in from Medicare, what's going to be coming in from your non-Medicare businesses. And this is a simplification. And when you do this on an Excel spreadsheet, you could break down that non-Medicare into your different commercial plans and so forth, and other payer sources. But you want to basically, on a week-by-week basis, estimate what you think you're going to have coming in by way of Medicare and non-Medicare revenue for each week, and plot it in. Now, how do you predict that? You know based on the volume of patients you see and how much you typically get for them, what you want to plug into that number. So you want to start plugging in for however long your revenue cycle is. So for instance, if it normally takes you 4 weeks to get paid, or 6 weeks to get paid, or 8 weeks to get paid, you know that what you see 4, 6, or 8 weeks earlier is what you're going to see in this week. And then that gives you on the fourth row there, you see revenue, gives you your total revenue you expect that week. Then you plug in your expenses. This is your output, payroll, mortgage, your supplies, any other insurance payments, automobile payments, whatever expenses you have. Again, on your Excel spreadsheet, you would have multiple lines there, and you plug in what expenses you anticipate coming in for those weeks. And then that gives you, down at the bottom is your balance. Now, of course, using my intake and output analogy, we don't mind in the healthcare world being in fluid overload. In a clinical world, fluid overload is not good. In financial world, fluid overload is great. What you really don't want in either scenario is dehydration. Dehydration is where your output exceeds input. So I show an example here. If you plot out a decline in your revenue and a steady state of expenses, you can see that by week 3, you get behind, and you're in a negative balance, which is a negative cash flow. Now, you have the option of filling that in by taking reserves from your personal funds or other company reserves and covering that. But if you're not in a position to do that, you have to start planning in week 1 or week 2 to maybe take some of the expenses and defer them until after things stabilize. And the important thing to do is to have discussions with your vendors if you need to do that. The worst thing to do is just to not pay a bill, and then when they call you, they're very angry and frustrated, and it puts you at a disadvantage. But if you call them ahead of time and say, look, this is what happens. This isn't a demand problem, it's a delay problem. All the colonoscopies I was supposed to do that got pushed off, they're going to be coming, So I'm sure I'm going to be able to pay you in 8 weeks, 12 weeks, 15 weeks, but you're going to have to give me some time. That's a much better scenario to be in than be in a situation where, you can't pay. And I'm sure, Roy can speak from a litigation point of view that communication is important to prevent litigation. You want to be upfront, tell them and approach it that way. So what I would suggest is plotting this out for 12 weeks and keep it rolling. And as each week becomes an actual week, plug in what the real numbers were and look at what you're predicting coming up and making sure how accurate you think you have been in the past, and if you need to modify it a little bit. So if anything, err on the side of negative. It's better to underestimate revenue and estimate expenses so that you don't find yourself behind. But the important thing is don't wait until week 3 when you're in the negative to start doing things. I would start in weeks 1 and 2 looking at what your expenses are, because if you can delay some of those expenses, you can make that negative number in week 3 a lower number, okay? So that's cash flow monitoring. Next slide, please. So now let's talk about what the CARES Act provides by way of opportunities for you to fill in the gap. As I said, in healthcare, we're not looking at a demand problem, we're looking at a delay problem. So, if you're a dermatologist, people who need, full body checks, or they need a skin tag removed or whatever, it's not that that need goes away, it's just that they can't do it right now and it's going to come later. Now, you'll lose some of it, right? We always know that if somebody has a stomach ache or a shoulder pain or whatever, and we all know, again, being clinicians, that after a certain amount of time, sometimes things just fix themselves. So they might not come back to see you. But for the most part, you're going to see an uptick in volume once the surge is over. Now, again, I warn people when they talk about, say, come June or July, being able to go back to normal. You as clinicians know, this pandemic's going to be with us for a year, 18 months. It's going to be here until they can develop a viable vaccine. All that's going to happen in June or July is the surge should be mitigated so that the healthcare system can deal with the thousands and thousands of people who become affected. But we're still going to have people who are going to be needing to prevent themselves from getting sick. So that's going to happen for a while. But the government, the CARES Act, is giving us an opportunity to get some money to mitigate that loss. The first one is through the Small Business Administration. This is for businesses less than 500 people. The Economic Injury Disaster Loan. This is a loan for up to $2 million with 3.75% interest rate for up to 30 years. Collateral is required, and you have to have a good credit rating in order to qualify this. The nice thing about this is that it does come with a $10,000 forgivable kind of advance payment, up to $10,000. I know a lot of people who have applied for this in anticipation of getting that $10,000. I haven't heard anybody getting it yet, so I don't know how much of that $10,000 you actually get. But this is a good opportunity, although it is low interest. It is a loan. It does require a considerable amount of documentation on your finances, and it does need to be collateralized. So I do know a lot of people have been reluctant to pursue that. The other one is the Paycheck Protection Program, and this is a much more advantageous program. It can be used to cover your payroll, your mortgage interest, rent, and utilities. The loan is for up to actually 2.5 months of your monthly payroll costs. So what you do is you calculate your monthly payroll. However, anybody who makes over 100,000 is capped in that process. So if you have, let's say if yourself is making 150, you're paying yourself 150,000 and everybody else is paid under 100,000, you would count everybody else at their full salary, and you would just count at 100,000. And that has a cap of $10 million. So I don't think too many of your practices would hit that cap. So, let's say if you have $100,000 a month of salary, that would be, you would get a loan of $250,000. Now the rate is a fixed 1% rate. I got to caution you, all these numbers change about every, 8 hours, it seems. No, seriously, every couple of days, new guidance comes out. I think it should be less now that it seems to be pretty firmed up, but if you have heard previous presentations at various times for about 24-hour period, the rate was 0.5%. Before that, it was 4%. The current rate, which I think is pretty much permanent now, is 1%. There's no payment for 6 to 12 months, and then it's a 2-year note. Now, the nice thing about this program is you can get up to 100% forgiveness. And that forgiveness comes when you get the, keep in mind, remember I said the loan is for 2.5 months worth of payroll expenses. You get the loan, and then it triggers an 8-week period, only 2 months, where you can spend that 2.5 months of payroll for payroll expenses, for interest on mortgage, for rent, and for utilities. And whatever you spend during that 2-month period for those things is eligible to be forgiven. 75% of that amount must be for payroll. 25% can be for rent, interest on mortgage, and utilities. The caveat is you have to rehire by June 30th the people that you laid off, if you had laid off anything. Although many healthcare practices are trying to avoid laying people off and because it's so hard to recruit good staff. So if this would help you maintain salaries. The nice thing about this too, the underwriting is very liberal and there's no collateral required. So, so the next slide, please. Loan proceeds, as I said, are used to cover payroll costs, mortgage, rent, and utility costs for 8-week period after the loan is made. Program is open to June 30th. The dollar value is capped. You may have read a lot in the newspaper about people worrying it's going to run out of money because so many people are applying for it. However, yesterday I read that the government's planning to fund an additional allocation of money to the program. So I think that's been recognized and is being addressed. The loan forgiveness is reduced, but even if you don't meet the full requirements for the forgiveness, it only becomes a 1% loan for the 2 years. So it's very cheap money to help you get through a crisis. You have until June 30th to restore any head count. It's pretty good. It's a pretty basic program. You have to, the best bet is to apply in your own bank. If your bank participates in the Small Business Administration program, they say it's going to happen very quickly. That's the intent. We have yet to see that. It can be difficult to apply. The portals are very bogged down with a lot of activity. If your bank doesn't participate, you need to find another bank who will, and unfortunately they typically put you behind the line of their regular depositors. So that's something to take into consideration. Next slide, please. Here's my contact information. I think it's a fairly simple application process that you could probably handle yourself with the help of your accountants. At Grassi, we have a program to help you generate that, which is reasonably priced. If you need help and would like to learn more, please give me a call. Or if you have any questions that we don't cover today, give me a call.
So just a couple of questions in the chat box that I think maybe we should address right now. So somebody said with, I think the one of the first slides, that they had read that the first 10,000 of the EIDL loan is forgivable. I think you sort of addressed that though.
Up to 10,000 is forgivable. Now I'm not sure what they say up to. I'm not sure the criteria for how they determine how much of that is forgivable, but how much they give you. But that is what they say.
Okay, and then we also have a question: is the interest accrued, and does the payroll protection plan apply to part-time offices?
The interest, it's a good question. I know the payment is deferred. I'm not sure if it accrues during that time. Don't know the answer to that, but I could find out if they needed it. And it would apply to part-time or full-time office. The chances are the part-time office would be a lesser amount because payroll would certainly be lower.
Mm-hmm. And if somebody has further questions, can they reach out to you directly?
Absolutely.
Great. Thank you.
Sure.
So with that, I guess we will toss it over to Roy.
Can Dr. Bailey ask a question?
We're gonna hold the questions if you
Oh,
don't
okay.
mind. If you have one, you can just type it into the chat and we'll.
Oh, I tried and then it went, oh, okay.
Yeah. Do you have a question for Joe? Do you want to just ask?
I do, yes. My employees are afraid to work, which is certainly understandable. They don't want to take the COVID home to their families. So I closed my office. I intend to keep it closed for 2 weeks, and they are applying for unemployment. Could I still at this point try to get a PPP? Am I understanding right that I just have to rehire them before June 30th? Did I glean the right thing from your slides?
Yes, yes. As long as you rehire them by June 30th,
Okay.
that's fine. And you're doing telemedicine, I hope, or
I'm a pediatrician.
you still could. If you need help with that, give me a call.
Oh, okay.
Okay.
Thank you.
Thank you. So, Roy, I'm going to unmute you.
Teresa,
Yes.
can you put Joe's information up for the public and, and then bring Roy back in 30 seconds?
Sure. I just have to go back to Joe's slide. 1 second.
Teresa, I'll type it in the chat so people can.
Oh, even better. Perfect.
Okay.
Thank you. Okay. Let's get Roy up here. Okay. You are off mute, Roy, and I am going to bring your slides up.
Great.
And we'll just,
Yeah, and if you go into slideshow, it'll do the same thing.
yep. Okay.
Okay,
Great.
so my name is Roy Breitenbach. I'm a partner at Garfunkel Wild. So I'm going to talk about some of the legal ramifications and kind of spin off what Joe was talking about. The concept of the payroll protection program, Paycheck protection program, is really to keep your employees employed for the 8-week period so that they continue to get a paycheck, doesn't strain the unemployment system, and everything moves forward. However, as Dr. Bailey just pointed out, there's a lot of different variations on this. Some employees don't want to come to work. Some some practices just can't swing it. So I'm going to go through kind of what the legal ramifications of all of those issues are. I'm going to hit the highlights. They're complicated areas. You have my contact information here. Please feel free to give me a call or send me an email. I'm happy to talk to you about specific individual issues because this whole subject is very complex and, like Joe's part of the presentation, very changing. So let's go to the first slide if we can. Okay, so the first thing you have to understand is about federal emergency paid sick leave. For those of you who are located in New York City, you know that New York City has had a paid sick leave program for a couple of years, but neither the state nor the federal government ever had a paid sick leave program. And so now with the advent of COVID, Congress passed as part of the Families First Coronavirus Relief Act, which was enacted about a week before the CARES Act, which Joe just talked about, adopted an emergency paid sick leave program. And so it applies from April 1st through the end of this year. And it applies to businesses that have 500 employees or less. So it's targeting the same audience as the CARES Act Paycheck Protection Program. Now, what's important about this is you can, as a healthcare provider, exempt your employees from these provisions. You can make a decision, as long as you inform your employees, that you're not going to participate and provide paid sick leave under the federal statute. That was done to encourage all the healthcare workers that needed to work or wanted to work during the crisis to work. And if you take a look at the regulations and the commentaries that the Department of Labor put out, the definition of who is a healthcare provider is pretty broad. It pretty much picks up anybody who is working for your healthcare practice that's enabling you as the clinician to provide services. So that would include front desk personnel, everybody else. So you have a business decision to make as to whether or not you want to offer this leave. or not. The concept of this leave, as we'll talk about later on, is that you're going to get a tax credit if you provide this leave that's designed to basically neutralize it out. So that any amount of money that you pay for this leave, you're going to get back in a tax credit on your payroll taxes. So, you know, in theory, accepting the time value of money, it's going to be a wash. So you can decide that this is a benefit you want to give your workers. If you do, it's in addition to any other paid leave. So it's additional. It doesn't run concurrently with city paid leave or any PTO you usually provide. It's a separate special benefit. So let's go now to the next slide. So the concept of it is that if your employee is under a COVID-19 related quarantine order, has been asked to self-quarantine by a healthcare provider due to COVID-19, or is an employee experiencing some symptoms of COVID-19 and is seeking a medical diagnosis, they can get up, if they're a full-time employee, 80 hours of leave at full pay. So that's 2 weeks. If you say a standard work week is 40 hours, that's 80 hours of, that would be 2 full weeks of pay. It is capped at $511 per day. So your highly compensated employees will be capped at $500. And they would have to establish that they're unable to work or telework because of one of these 3 conditions. So they would have that, if they do have one of those 3 conditions, you can pay them up to 80 hours of leave, capped at $511 a day, and that's what they would get. So let's now go to the next slide. Now, there's a secondary benefit if the employee is caring for somebody in their family who's subject to a COVID-19 quarantine or isolation order, or is experiencing COVID-19 symptoms. If they fall under that, so they're taking care of a family member, a mom, a dad, a spouse who's suffering from COVID-19, or if they're caring for their son or daughter because the school is closed or the child care provider is unavailable, and the employee is unable to work or telework, they'll get the 80 hours of leave as well, but it's only capped at a 2/3 rate of pay. And that's actual cap of $200 per day. So they'll get 2/3 of their ordinary rate of pay, up to $200 a day for the 80 hours. And so if we go to the next slide, before we talk about the family extended and family and medical leave, which is another benefit, I want to add that the 80 hours will be prorated if you were a part-time employee. So for example, if you worked half-time, you'd get 40 hours of paid leave rather than the 80. If you worked a quarter of the time, you'd get 20 hours of leave. So it's dependent upon how frequently and how much you work. So that's the issue with the paid sick leave. And dovetailing with the paid sick leave is the next benefit, which is the federal extended family and medical leave. So this is another program. It also takes effect April 1st, 2020. It kind of extends the federal family and medical leave benefit, but it applies to employers with less than 500 employees. So it really picks up most of your small practices. And like these paid sick leave, you make the decision whether or not you want to offer it if you're a healthcare provider. If you decide you don't want to offer the benefit because you don't want your healthcare, you don't want your employees to get it, that's up to you, as long as you tell them in the first. And what we're getting a lot of questions of, and we think is pretty clear under the regs, you can make a decision to offer one and not the other. As a healthcare provider, you could say, I'm going to decide to exempt my employees from this extended family and medical leave, but I do want them to get extended sick leave. And this works much the same way as the paid sick leave works, is if you do decide to pay your employees benefits under this provision, there's the tax credits that are supposed to neutralize it out at the end. The only requirement on the employee side is you can only give this benefit to employees who've been employed for 30 calendar days. So that's the requirement there. So if we go to the next slide. Now this is a lot more narrow of a benefit than the paid sick leave. So the only people who are entitled to claim this leave is if the employee is unable to work or telework because they're caring for a son or daughter who's under 18 years old if their school or their place of daycare has been closed or the child care provider is unavailable because of COVID-19. So only in that circumstance where, you know, your employee is saying to you, I can't come into work, I gotta watch my child because schools are closed, there's nobody else who can do it, okay? And by the way, I can't telework because I'm hands-on or because my child is small and I can't divide my attention or whatever the reason. It falls into that group of employees only. And for that group of employees, they get 12 weeks of this leave, okay? The first 2 of them are unpaid, but they could use another benefit that would apply for it. So for example, they could use the 80 hours of paid sick leave we just talked about. They could use whatever PTO paid time they have under your usual benefit programs. They could use the New York City paid leave for part of it. So whatever they need to do to fill in all or part of that first 2-week gap, they can use. Once that 2 weeks gap is over, they get the remaining 10 weeks at 2/3 of the employee's regular rate of pay, capped at $200 per day. So one of the more important things to remember about both of these provisions is that there are extended job protection benefits that are associated with this. What that essentially means is you can't take a retaliatory action against an employee who takes either paid sick leave or this extended family and medical leave. And if they do take the extended family and medical leave and they're out a period of time, 10 weeks, 12 weeks, whatever they're out, you have to guarantee them the same or essentially the similar job when they come back. So there's a guaranteed employment position requirement for this. So, you know, if you are staying in business and you do decide that you want to do this for your employees, you can do this for your employees. And as I said, you will get a tax credit as a result. So let's go to the next slide. So the tax credits were designed to pay 100% of these payments, okay? And what's come up is that, first of all, people start to ask, well, wait a minute, if my payroll is shrinking, I may not have enough payroll taxes to cover the benefits I'm paying out. And what the administration has said is that if your payroll is shrinking, and as a result, your payroll taxes that you pay every month or every quarter are insufficient to cover the amount of paid sick leave and paid family and medical leave benefits that you paid for that quarter, we're going to write you a check for the difference. So you're going to be kept whole for all of this. So the only thing you're going to have to really be concerned about is you're laying it out at first by paying it to the employees as part of their regular paycheck, and you're going to have to wait to get the credit at the end of the quarter, okay? Talk to your accountant about this. There are various provisions, technical provisions in the statute. Depending on how you pay your payroll taxes, you may be able to go into the depository account for your payroll taxes and take out the amount that represents the leave. But I would talk to your accountant about this to make sure you don't run afoul of any federal or state rules about this. But as I said, the intent is that if you do decide to give this benefit, you're going to get the tax advantages back. So let's go to the next slide. New York State has its own paid sick leave, which doesn't have a tax credit directly associated with, which is a little different. It's much more restrictive. The employee has to be subject to an order of quarantine or isolation, okay? That has to be issued by a state or local health official. So it's not just that they went to a doctor and the doctor said, oh, I think you have COVID-19, I want you to quarantine. It actually has to be under a state or local health department order, or they have to be watching somebody at home, a family member who's under such an order. And in that case, depending on your size, you may have to give them some paid sick leave. If you have 10 employees or less, it's unpaid sick leave unless you had over $1 million in net income in your last tax year. And then you have to provide 5 days of this paid sick leave. And then for the duration of their being out or under a quarantine order, they can use paid state family leave or disability benefits. Let's go to the next slide. If your practice has between 11 and 99 employees, you have to provide the 5 days of paid sick leave. And then again, they can use unpaid sick leave for the duration of the order, and also can use paid state family leave or disability benefits. And finally, if you have over 100 employees or 100 employees or more, you have to provide 14 days of paid sick leave. So this is a different benefit. It's very much different from the federal paid leave benefit. The one thing I will say about this is there's a specific provision in the New York State paid leave law that says if Congress has a paid leave law, that's the one that controls, unless the state would provide a greater benefit. So in most cases, employees would just get the federal if they qualify for the federal and would not get the state. There's very rare circumstances in which you would be entitled to the state. It would essentially have to be a situation in which in which it was more than 80. You have to be out for more than 80 days a week, 80 hours in a 2-week period. So let's go to the next slide. There is a caveat in the New York State paid leave law. You don't get paid leave if the employee has no symptoms or has not been yet diagnosed with any medical condition and is physically able to work or telework. So similar to the federal law, if you're able to work or telework and you're asymptomatic, you don't get the benefit. So that's New York State paid leave law. Let's now go to the next slide. So a lot of people are coming to me about the concept of furloughs, right? And that's the concept of, I don't know what's happening. I don't have a lot of people in my practice. I like my employees. I want to do the best I could do for them, but it's probably in my best interest to lay them off or furlough them temporarily until volume comes up and revenue comes up, and or reduce their hours so that we can get through this crisis. Because as Joe pointed out, it's a question of timing. The demand is there. It's a question of timing. And so many employers are calling it a furlough, a termination, a layoff. It doesn't matter what you call it. For purposes of New York law, it's truly a termination. And as a result, when you do it, you need to provide a record of employment form to each employee so that they can take it to the unemployment insurance division so they can get unemployment. You need to provide them with a termination notice or a notice that they're being laid off or furlough. You have to provide them a, quote, final paycheck on their next scheduled payday. If you're not picking up their continued health insurance, you need to give them a COBRA notice. And if your policy in your office is that you generally pay accrued but unused PTO when somebody leaves, you're going to have to write them a check for the accrued but unused PTO. If your policy is never to do that, you don't have an obligation to do that, all right? So let's go to the next slide. A lot of practices are looking at this as somewhat less than a furlough where you completely don't pay the employee and completely put them out of work, but rather you maybe reduce their hours in combination with or in addition to a reduction in pay. You're entitled to do that under certain conditions, okay? First of all, if you want to do it so that the employee gets unemployment insurance, in New York, you get unemployment insurance if you work less than 4 days a week and you earn less than $504 per week. So that's the trigger for unemployment insurance. Now, as many of you probably know, people who are working for your practice are classified as either exempt, meaning that they're not paid hourly, they're paid a salary, and they're professionals, executives, or fall under, or administrators, and therefore they have an exemption from the wage and hour laws, or they are what we call non-exempt hourly employees. For your exempt employees, you can cut their salary. You just have to make sure they don't fall below the threshold, which takes them out of the exemption and makes them have to be treated as hourly employees. So we'll go through that threshold in the next slide, but that's a very important point. You have to be careful about that, okay? You could consider taking your employees who are earning a salary and making them all hourly employees, which means that you can cut their compensation down to the minimum wage. You just then going to have to pay them overtime if they're entitled to overtime. And if you have exempt employees and you're doing any change for them, you're laying them off, you're reducing their salary, anything in terms of a change in compensation, you have to do it at the beginning of a work week. Once a work week starts, they're entitled to that same rate of compensation, that same number of hours worked for the entire week. If you don't do that, you potentially violate the Fair Labor Standards Act, and you could be subject to fines. So let's go to the next slide. So here's the exemptions. If your employee falls under the executive or administrative exemption, and that's why they're getting a salary, they're not an hourly employee, their weekly salary for full-time work cannot dip below $1,125. If it does, then you have to treat them as an hourly employee, and they're entitled to overtime for anything they work in excess of 40 hours. So, and obviously if they're a part-time employee, you prorate that $1,125 out, right? For professional employees, okay, the weekly salary for full-time work cannot fall below $450 a week. And the reason why there's a discrepancy between the two is that New York State has a higher threshold for executive or administrative employees, but doesn't have any threshold for professional, so it falls down to the federal threshold, which is much lower. It's $455. And if you're a physician, you're entitled to the professional employee exemption regardless of your weekly salary. So you can cut your physicians down to the bone. In terms of a weekly salary, they would still be treated as an exempt employee. So let's go to the next slide. If you're going to change your employees' rate of pay, you got to give them a change form. For your hourly employees, you got to make sure that they're doing the minimum wage, and you have to ensure compliance with employment contracts and collective bargaining agreements. You need to make sure that if for your employees that are under employment agreements, if you're cutting their salaries or cutting their work hours, that's potentially a breach of their employment agreement. They can sue you for breach of contract. You potentially have a defense that it was impossible for you to perform because of COVID-19 and you were doing what you were doing out of business necessity, but it's vitally important that you talk to a lawyer about that to go through the issues and what the ramifications and potential exposures of that are. The other thing you have to be careful about, if you cut employees' hours and they're getting healthcare benefits, you need to check with your healthcare broker to make sure by reducing their number of hours or putting them out of work, you're not jeopardizing their healthcare coverage. Group healthcare coverage, depending on the plan or arrangement you have, may prevent somebody from getting that coverage if they work a low number of hours or they're out of work for a period of time. You need to go through that with your broker. And finally, the Unemployment Insurance Division has programs for shared work in which you take all your employees and you reduce their number of hours, but to keep everybody at work. If that's something you're interested in exploring, I urge you to go on the unemployment website and take a look at it. It might be something that would be good. The advantage of those programs is you pay a reduced salary, the employee gets some unemployment, but it basically lessens the amount of unemployment that gets paid and lessens the amount that you have to pay. So it's kind of a win-win. So let's go to the next slide. Let me talk real quickly about unemployment. Unemployment at the end of the day is a traditional benefit under state law. However, okay, Congress, as part of the CARES Act, passed an enhanced unemployment insurance, right? It both increased the appropriation for unemployment insurance and expanded eligibility. So everybody should be getting, starting in, I believe it's this week, an additional $600 weekly benefit for 4 months over and above what they would ordinarily get under state law, okay? That's directly related to COVID-19 and is a fantastic benefit, okay? They've also going to get an extension of unemployment insurance benefits for 13 weeks to now get 39 weeks of unemployment insurance. And unemployment insurance traditionally didn't apply to the self-employed, independent contractors, or so-called gig economy workers. With the passage of this enhanced unemployment, workers who fall into those categories would be entitled to unemployment insurance benefits. So let's go to the next slide to see how it all works. So again, you have to make a distinction in New York between those who were traditionally able to get unemployment and those who were not. So let's go to the next slide. For traditional eligibles, you're now entitled, so people who are ordinarily regular employees, not independent contractors, not self-employed, not gig economy workers, those employees will be entitled to 39 weeks of unemployment benefits. And for the period of time, April 5th through July, end of July, they get $600 per week over and above what they would ordinarily get. Let's go to the next slide. For traditional ineligibles, so people who are self-employed, independent contractors, gig economy workers, if they can't work because of COVID-19, they're entitled to what's called pandemic unemployment assistance, which gives them 39 weeks of benefits and an additional $600 a week through July 31st over and above what they would get under regular unemployment. And let's go to the next slide. And finally, you may have people who were intermittently in and out of work and they've exhausted their unemployment benefits at some point since July 1st of 2019. So people who may have had a period of unemployment, exhausted their benefits, they're now working for you, and you got to put them out again, they can get an additional 13 weeks of benefits, and through that, they can also get an additional $600 a week. So if you make the decision to furlough employees, they will get unemployment benefits. So one of the things that you really have to do is model out with your accountants as to what's the most advantageous for you and for your employees in terms of keeping the business afloat for the next few months. The one thing I forgot to add at the beginning that I'll add now at the end is that if you pay paid sick leave and paid family leave benefits under the federal law, the amounts that you pay are not considered part of your payroll for purposes of the Paycheck Protection Program loan, because you're already getting a tax credit for it, right? So they're not, the government's not going to allow you to double dip. So any amount that you pay for paid sick leave or paid extended family leave under the federal statute is not considered payroll for purposes of getting a Paycheck Protection Program loan. And so now if we go to the next slide, and the slide after that has my contact information, I'd be happy to answer any questions.
Thank you, Roy. That was really great. I don't see any questions in the chat. If anybody does have a question that they'd like to throw out to Roy right now, you can unmute yourself and go ahead and ask him. Otherwise, we'll let Henry sort of wrap things up for us.
My name is Sydney Piggott. I put in a question. Does this apply to a new part-time hire who only logged in only 3 weeks?
So somebody you just hired, you want to know whether or not?
Yeah, who I just hired. And then the COVID, go ahead.
Yeah, so so everything would apply to that. So paid sick leave would apply to them if you choose to give it to them, right? Because you're a healthcare provider. They would not be entitled, if you just hired them 3 weeks before, they would not be entitled to the extended family and medical leave because they haven't worked for 30 days. And they would be entitled to the New York paid sick leave if they were entitled to it. And then I believe that that's an insufficient time to get on, if you put them out to get unemployment, that's something you would have to check for unemployment insurance. I don't know. I think there's a minimum amount of weeks you have to have worked, but I don't know what that is. They may be entitled to the pandemic unemployment assistance, because they can show that they just started a new job and got and were put out because of COVID-19.
Okay, thank you.
I see a hand up, Dr. Belzy.
Yes.
Go ahead.
So I have a small private practice and I only have 2 employees. But if it happened that those 2 employees called me and said to me that they cannot come to work because of what's going on now, and I cannot force them to come back to work. So how can I deal with that? Do I have to let them go and replace them by something else, and then I would still be responsible for those 2 employees?
Well, those employees, if you go through all the different benefits that they could be entitled to, it doesn't sound like they would be entitled to, they surely would be entitled to New York State paid sick leave because they're not staying home because there's an order that requires them to stay home, a state or local health order. They may be entitled to New York State, they may be entitled to federal paid sick leave, to 2 weeks of paid sick leave, if they could establish one of the reasons, right? If they have some symptoms of COVID-19 and they were told to stay home, if they have some symptoms of COVID-19 and they're seeking a medical diagnosis, or if they're home because they're watching a child because schools are closed, they're theoretically eligible for paid sick leave. And if they're home for watching a child who's home because their school is closed, they would also be entitled to extended family and medical leave. But if you're a healthcare provider, so you can make a decision that you're going to not do those benefits for your employees. That's your choice. If you choose to give them those benefits, then you have to pay them those benefits, give them the leave, and when the leave ends, you have to restore them to their regular positions. If you decide that you don't want to give them those benefits, then that you can put them, they're out. They're not getting any compensation from you, and you don't have any responsibility for them. And then the question becomes whether or not they can apply for unemployment. Traditionally, an employee who applies for unemployment has to establish that they're ready, willing, and able to work. In the situation you gave me, there sounds like there's an issue as to whether or not they're ready, willing, and able to work. My understanding is that unemployment is significantly softening that requirement given COVID-19, and as a result, they probably would get unemployment insurance if they applied. But as long as you don't choose to give those leaves that I talked about, you don't have any obligation. Once they've stopped working, you don't have any obligation to them.
Thank you.
And I think we'll take just one more. There's one more question in the chat box. If I take one or more of my staff got sick, I can pay them 80 hours since they're hourly employees and arrange with my payroll as sick leave. I'm not sure if I'm interpreting that the right way.
Yeah, well, if you can only give the 80, look, you could only give the 80 hours of paid sick leave under federal law if they meet one of the requirements, right? So you would have to show there's the 6 requirements. The first 3, they get paid at 100%. The last 3, they get paid at 66%. The first 3 are if they, one, have COVID-19 and have been told to quarantine, or a doctor has told them you have the symptoms and we're checking it out, but you should stay home, or they have some of the symptoms and they're getting they're seeking a diagnosis. They can get paid at 100%. If they're just watching or treating somebody else or home because their child is home, then they get it at 2/3 pay. So you're not going to get it. So that's what qualifies for federal paid sick leave. And, you can't, so that's the only reasons why you can pay federal paid sick leave. If you pay sick leave beyond those reasons, you're not going to get a tax credit for it.
Great. Well, I want to thank you, Roy and Joe, both for really a fantastic presentation. I know there's a lot to cover, and the fact that we got so much out of the way in just under an hour, I think is amazing. And I hope everyone's questions were answered. And hopefully any follow-up questions, they can reach out to you both directly. There will be a recording posted on the HITS website. So if you didn't catch everything and you'd like to come back and review it again, we will be sending out the link to the recording. Henry, did you want to say anything as we wrap up?
Thank you very much. Thank you, Joe. Thank you, Roy. And thank you, everyone in the assistance. I hope that this has been helpful. I know that this is the first one. And some people didn't get a chance to get in, so we might have a repeat. But as Teresa said, that this has been recorded and we will post it on the HITS website. Everybody who registered will get an email, I would guess, right, Teresa? And then at their leisure, they can review all the information. And you all have Roy's information and Joe's information, and you certainly can reach out to them if you need help. Thank you, everybody. Bye now.
Everybody stay safe.
Yeah, stay safe, everybody.
Bye now.
Bye.